What if I told you that the most consequential market signal this entire weekend was not a missile launch, not a signed peace treaty, and certainly not a politician posting on social media? What if the loudest warning bell in the global economy is completely silent, echoing only in the concrete walls of a warehouse in New York? Right now, the financial media is obsessed with the theater of geopolitics. They want you watching the skies and reading press releases about failed negotiations. But while everyone is distracted by the noise, something massive is being quietly drained out from underneath them. It is the kind of wealth transfer that usually precedes a historical shift, echoing the very days just before the London gold pool collapsed in 1968. The paper markets are projecting a temporary illusion of stability, but the physical vaults are telling a story of quiet panic. If you are someone who is tired of the manufactured distractions and wants to understand the brutal mathematics actually driving the global system, make sure to hit the subscribe button and give this video a thumbs up, because what we are about to uncover requires a structure of thinking they rarely show you on television. We need to look past the paper and look directly into the vault. To truly grasp the magnitude of the quiet panic unfolding in the global markets right now, you have to understand the specific anatomy of a bank run. But this is not a run on a local branch for fragile paper currency. This is a run on the foundation of the commodity exchange itself, specifically the COMEX. Now, retail investors and even seasoned financial commentators often make a critical, almost fatal error when looking at silver inventories. They look at the massive pile of metal sitting in approved vaults and they feel a false sense of security. They call this the eligible pool. But eligible silver simply means it meets the purity standards and happens to be resting inside a designated warehouse. It is someone else's private property. It is not for sale. It is essentially a museum exhibit. You cannot touch it. The only metal that actually matters, the only metal that acts as the operational heartbeat of the global pricing mechanism, is what we call the registered pool. Registered silver carries a warehouse warrant. It is a transferable title document that makes that specific metal immediately deliverable against an outstanding futures contract. Right now, that registered pool is flashing red. As of the latest Friday report, which anyone can verify through the exchange records, that registered inventory sits at approximately 79,800,000 ounces. That might sound like a large number to the uninitiated, but in the context of global industrial consumption, it is a rounding error. It is a puddle trying to satisfy an ocean of demand. Let us put that 79,800,000 ounces into its proper, terrifying context. Over the 5 complete months spanning from December of 2025 through April of 2026, the exchange witnessed an absolute exodus. Buyers stopped playing the paper derivative game and started demanding their actual metal. In December, nearly 64,700,000 ounces were delivered. January saw another 49,400,000 pulled from the system, then 25,200,000 in February, 46,100,000 in March, 16,600,000 in April, and May has already added roughly 25 million ounces in delivery notices. If you are keeping track of the math, that is a 6-month running total of approximately 227 million ounces of physical silver removed, delivered, and gone. Let that ratio burn into your mind for a moment. The market has delivered roughly 3 times the amount of silver that currently sits in the registered pool, all in under half a year. That is not normal market behavior. That is an accelerated, systematic stripping of physical assets masked by a paper market that still pretends everything is perfectly fine. The paper price bounces around $80.71, but the vault is bleeding out. And you have to ask yourself, why now? Why are the entities with the deepest pockets quietly draining the physical reserves, while the public is intentionally distracted by missiles in the Middle East and parliamentary posturing? Because the smart money is looking at the underlying rot in the domestic economy. They see what the central banks refuse to say out loud. Right now, there is an absolute crisis quietly unfolding in the labor market. We are seeing data indicating that roughly 1/3 of the prime-age male workforce in the United States is essentially out of the labor pool entirely. You have a new generation of college graduates stepping into an economy where their specific unemployment rate sits somewhere around 8 to 9%. Just 3 years ago, 70% of graduates believed it was a good time to find a job. Today, that number has collapsed to a staggering 27%. The official non-farm payroll numbers have effectively regressed back to levels we saw in early 2025. The trend is undeniably weakening, and the central planners are trapped. So, what does a weakening labor market mean for a Federal Reserve that is backed into a corner? It means the inevitable pivot. The Federal Reserve has 2 conflicting mandates: to fight inflation and to maximize employment. But the powers that be have made it clear they will protect the labor market long before they slay the inflation dragon. They are trapped in a cycle where they must eventually lower interest rates, regardless of whether inflation is actually tamed. The Federal Reserve Bank of Chicago president recently had to admit publicly that inflation has stopped cooling. It is not heading toward their magical 2% target. Instead, it has accelerated. The conventional academic theory tells you that higher inflation expectations and higher interest rates should create headwinds for precious metals. They tell you that a stronger dollar suppresses demand. And yet, the price of silver punched through $80 anyway. It completely ignored the textbook because the textbook is written for a paper economy that is currently unraveling. When you combine stagnant or sticky inflation with a central bank forced to cut rates to save a dying labor market, you get lower real interest rates. The dollar weakens, and the true cost of holding paper money becomes unbearable. The global elite know that quantitative easing, or some covert version of it, is coming back. The printing presses will run again because they have no other mathematical choice. And when the currency is diluted to save the system, physical assets like silver are the only lifeboats that do not leak. This realization is not just a Western phenomenon. In fact, the East is acting on this mathematical certainty with aggressive precision. While Western investors stare at their screens, trading emotional headlines, sovereign nations are loading up transport ships. Take China, for example. In March of 2026 alone, Chinese customs data reported the importation of approximately 836 metric tons of physical silver. That is not a speculative anomaly. That is a single-month import record, representing an astonishing 173% increase over their 10-year seasonal average. The Chinese government has actively classified silver as a strategic material since January. And if you look at the Shanghai Futures Exchange, physical silver has been trading at a premium of roughly 12 to 17% above the international paper benchmark for months. A persistent premium like that is the market screaming that the paper price is a fiction. The East is happily paying a massive premium to acquire the physical asset, knowing that the Western paper price is being artificially suppressed to maintain the illusion of a strong fiat currency. Then you look at Turkey, a massive geographical and geopolitical bridge between Europe and Asia. In January of 2026, Turkey imported approximately 237 metric tons of physical silver. That is the highest single-month procurement in their recorded history. A nation positioned as a global refining hub does not suddenly import a massive fraction of its annual volume on a whim. This is a deliberate, forward-looking action by industrial and government planners. They are looking at a global supply chain that the Silver Institute projects will run a deficit of approximately 46 million ounces this year. That makes 6 consecutive years of global supply deficits. 6 years where the world consumed more silver than it pulled out of the ground, drawing down global above-ground stocks by roughly 762 million ounces. And unlike gold, which sits in a vault and gets counted generation after generation, silver is an industrial workhorse. It is consumed. It is destroyed. It is placed into solar panels, medical devices, high-end electronics, and advanced weaponry. Once it is used in these microscopic applications, it is economically unrecoverable at typical market prices. It goes into a landfill. It is gone forever. You cannot print silver to meet that demand. You can only drain it from the vaults until there is nothing left. This creates a profound psychological divide in the market right now. Retail investors, conditioned by decades of quick dopamine hits on trading apps, are completely focused on the headline of the day. They see a news alert about a peace treaty framework, they see the oil price twitch, and they panic sell their paper silver contracts on a peace premium unwind. They trade the emotion, but the institutional entities, the sovereign wealth funds, the central planners in the East, they do not trade emotion, they trade tonnage. They use every single paper price dip, every emotional panic generated by the Western media cycle, to simply back up the truck and take more physical delivery. They are playing a game of accumulation, while the West plays a game of speculation. This exact dynamic, this precise arrogance of a paper system trying to dictate the price of a physical reality has happened before, and it ended in spectacular, violent failure. To understand what is coming for the silver market, you must look back to the collapse of the London gold pool in the late 1960s. Back then, the United States and a coalition of European central banks arrogantly believed they could force the global market to accept gold at $35 an ounce. They created a paper derivative system, a massive pool of resources to dump onto the market whenever the price threatened to rise. They thought they could manipulate the math forever. The financial media of the time told the public everything was stable. But behind the scenes, smart operators saw the structural deficit. The United States was fighting an expensive war and funding massive domestic programs. They were printing dollars, exporting their inflation, and pretending the currency was as good as the metal it represented. But France saw through the illusion. They knew the paper dollar was losing value, so they stopped playing the paper game. They began demanding physical gold in exchange for their dollars. They literally sent ships across the ocean to load up the physical metal from the vaults in New York. The drain was slow at first, almost imperceptible to the average citizen watching the nightly news. Then it accelerated. The central banks panicked, dumping more and more of their physical reserves into the London market to suppress the price, hoping to bleed out the buyers. But you cannot bleed out the mathematical truth. By March of 1968, the physical drain became a torrent. The vaults were hemorrhaging metal at an unsustainable rate. In a matter of weeks, the entire paper scheme collapsed. The London gold market had to be abruptly shut down, closed for 2 weeks while the central planners scrambled in terror. When it finally reopened, the artificial peg was dead, the free market took over, and the price of the metal exploded, leaving anyone holding the paper currency holding the bag. Today, the COMEX silver market is the new London gold pool. The suppression is identical. The paper derivative market dictates a price that the physical reality can no longer support. The illusion always holds until the vault is empty. So as we look toward the opening bell this Monday morning, there are 3 distinct paths this could take. First, if the weekend passes quietly without a formal response from the Middle East, silver will likely open near its current range, testing whether $80 can hold as a new solid floor rather than a temporary ceiling. Second, if we see a definitive diplomatic rejection or unexpected military escalation, oil will spike, and the paper-silver price might actually drop in the initial panic as institutions aggressively scramble for dollar liquidity. But you must remember, every previous paper dip in this cycle has simply been a loading zone for the physical whales. The third and perhaps most dangerous scenario for the uninformed retail trader is that a peace framework is actually accepted. The financial press will celebrate, oil will drop, silver might sell off by several dollars as the temporary peace premium unwinds. The talking heads will confidently tell you the metals run is over. But a political signature does not magically put 227 million ounces back into the registered vaults. It does not reverse 6 years of global industrial deficits. The physical reality simply does not care about the geopolitical theater. The vault only cares about the math, and I always leave the exact links to that math below so you can verify the data sources yourself. If this analysis changed how you view the global financial system and you want to stay ahead of the daily shifts, hit subscribe, leave a comment below with your exact strategy for Monday, and I will see you in the next one.